Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of The Options Playbook, and I'm going to be your host for probably 20 minutes today. We've already set up quite a few trades, and oddly enough, I don't know why I kind of felt this way. The Coca-Cola trade, the KO trade, worked out. It was a very, very simple trade, just odd to sell something around earnings just with no volatility whatsoever. And it was just a follow through. We saw Pepsi make a big run up, have their biggest move after an earnings report. And probably, I don't know, someone said it was like 3 or 4 years since Pepsi made a 7 or 8% move after earnings. And so Coke, piggybacked on that and ran up. And then they announced earnings and they went down. And that just seems to make sense to me, and I don't know why. I very rarely would put a trade together on Coke, but I really like that trade. So Coke right now, there's nothing to show. There's really no premium left. The option contracts are trading for next to nothing, so I don't want to waste a lot of time setting it up. But we sold the 72.50 and the 75, so 2.5 point wide short call spread, anticipating the market would stay below 72.50. Market opened down after the announcement. The market went down and it stayed down, and we're now at 68.81 with 80 down 85 cents, down another 1.24% today. And we got the August 15th expiration. So the only it's trading for next to nothing. The option contracts are right now, but the thing that is also true about it is we had to go out to August 15th to get a decent amount of premium. We were selling a short call spread around earnings. And normally you would do something like maybe the August 9th or August 1st or August 8th expiration. We had to go all the way out to the 15th just because there was no premium in Coke. Just very rarely do an earnings play on Coke, but I felt the timing was right and the trade worked out, give or take, if that was lucky or not. All right. So this week we've done a trade in Google, and I think out of the mega cap tech stocks, Google shows the most potential for a move after earnings. One of the more level valued of the mega cap tech stocks. It's still getting beaten up because of AI, even though they're making a lot of strides in the AI space. And one of the biggest things about Google is they just really like to keep everything, close to their chest. They don't talk much about forecasts, about how well the company's doing. And I do think that hurts them after their earnings reports, but maybe in the long run, it's a good thing. But then if we look at that trade in Google, we have a long call spread that we are going to put on. And we'll take a quick peek at that trade and reiterate. They're going to be announcing earnings after Wednesday, after the close. And then also IBM. So I'm going to go back and look at the chart on IBM. IBM has been a darling of the stock market also, right along with Netflix. And it's interesting to see kind of the move I guess I don't think IBM is up more than Netflix. Netflix really took off after their earnings report. But once again, you got, the steep diamond rated ski hill here on the way up in IBM. And then we stalled, came back down, and actually broke below the 20-day moving average. I would expect the 50-day to provide a little bit of support here. But the area that we're talking about where we're going to see a lot of support or resistance to the upside would be the 295 level. So because of that, I think we're going to set up a skip strike butterfly in IBM. They're announced on a Wednesday. Ideally, it would be a little bit better if we did it on a Thursday. If anybody has any power at IBM, if you could get them to change it to Thursday, I think that would be very helpful so that we would have a 0 DTE option trade. But at this point in time, we're going to have to do with what we have. So we're going to be looking at the July 25th expiration, which is Friday. The expected move in IBM is right around 19. We'll call it 19 points. 1840, right? So we'll call it right about 20 points. So 85, 95, 305 is about the expected move. And then you always want to kind of check this. So like if you see this, that's usually equates to about a 20 delta. So there's a couple of ways to skin the cat. You can just look for the 20 delta because that's usually about where the expected move is as far as the strike prices are concerned. And then if you want to look at a 1 standard deviation move, which I love about the Tradier Pro options grid, is it highlights that range, and that's usually about a 16 delta. You're usually somewhere right around that. So as far as probability is concerned, that's where these numbers come from. And so a 1 standard deviation move, which represents 16% of the time the stock will go at least a 1 standard deviation move or beyond, based off of delta. And that's at right around 310, almost exactly, because we're right at 16 delta. So we're going to center around that. So we'd like to get to the expected move, saying that this is probably within the range, and that's about 305. And then we could do, let's see if we can get 7.5. That's 260. No, we're going to have to do the 310. Okay, so if we can get the 310 in, that's good enough for me. We're going to buy the 280, sell 2 of the 310. And so that's 5 points wide. The standard, and I'll put this in just for a second for show. So the standard butterfly in this instance would be this, and that's trading for 25 cents. So if you watched Options Guide TV around earnings, around skip strike butterflies, what we're doing is we're effectively selling a call spread to pay for a butterfly. So we need to cover 25 cents and then get at least a credit above and beyond. So by skipping the strike, that means we're basically selling it, and we're going to remove that leg. And then we're going to come back and we're going to skip the 2015 and look at the 320. We'd have to go all the way up to about the 327.50. Yes, it's going to be tough to get this done for a net credit then. Let's hit that one. Not bad. All right, so that's 93. Let's go all the way back to the 320. Let's clear this out and buy the 320. 10, 50. Yeah, there we go. 90. Is that staying there? 22-cent net credit. Okay, so normally our rule is we'd like this to be about, if we're going to have $5, we'd like to get 50 cents on the trade overall, but we can get this done for a net credit of 20 cents. So we got $5 of risk. Let's send this to the what if calculator. And here's where our risk comes in. This will be our official paper trade. To go along with the Google trade that we have on, we are going to, with the market at 285.56, we're going to go out the expected move to around 305. And then we're going to go beyond, and we're going to get to the 310 level, which is about the 1 standard deviation move. And then we're going to skip this strike. And that by skipping that strike, we then get this done for a net credit, but we add $5 of risk, that short spread from 315 to 320. That is the issue. And then we bring in a net credit of 21 cents versus doing the standard butterfly, which needs it to land within a range, right? That standard butterfly would cost us 25 cents. So if you look at the math and you think about this, that short call spread from 315 to 320, 5 points wide, would be trading for 50 cents. And we're going to use some of that to generate net credit for the account and put the hedge in our trade. And that's where the skip strike butterfly comes from. So I always like to think of the skip strike butterfly as an alternative to a short spread, as opposed to an alternative to a butterfly. Now, some people will call it the modified butterfly, and some people will call it the broken wing butterfly. I don't like that, because that puts the butterfly as the main situation. What we're literally doing is skipping a strike and embedding a short spread. So I like the skip strike, and that's the way I named it in my book. 15 cents. I don't want 15 cents. We're going to adjust. If we can't get it done for the initial price that popped up here, which was 22 cents net credit to the account, I would adjust the strikes. I don't want to take less than 20 cents on the trade. Now, here's the good news. The good news is that if the market goes down, we make that. So 22 cents, anywhere from 260 all the way up to 305. By Friday, if the market's in that range, we'll make the 22 cents. The market continues on up. You see, when you initially put this trade on, just like in a short spread, when you initially put the trade on, if the market goes against you, that hurts. You need time decay to help you. Well, also volatility crunch doesn't hurt that bad either. So we're going to get that volatility crunch, which will bring this green line closer. But if the market does make that, beyond expected move jump on the open, we're going to probably be in a little bit of pain, even if we get to the middle strike, which is the 310 level. So keep that in mind. And if it does, just get out. Take your loss. If you open up tomorrow and the market gaps open at 310 in IBM, get out of the trade. Don't let this thing run against you. And that's always my golden rule with these, is that if it does hit the short strike and it happens right away after the earnings report, you just get out of the trade. Beyond that, if ideally you land half of the expected move, this would be the ideal scenario, and the stock just drifts this way, then you can completely control it, because then you have huge rates of time decay all day Thursday, all day Friday, and implied volatility comes in and you have a hedge. So this is totally different way to approach it. If you had a short spread on and the market moved, to 303, you got to be nervous the whole time. There's nothing to look forward to, right? If the market is starting to go towards your short strike of your short spread, which would be the 315 level, right about here, where our break even is at. And if that is the case, then on this trade, you'd be forced to get out. You just don't want to take that max loss, and it would be hurting you very, quickly, I guess is the only way to say it. All right. So if we have any questions about this trade, can you do, yeah, go ahead. Let's put the second one up. Can you cover a max profit scenario? All right, Chad, we can do that. So in the max profit scenario, and this is what's really fun about the skip strike butterfly, you're putting it on for a net credit of 22 cents. You can also take it off for a net credit. The maximum net credit would be the width between this strike and this strike. So the width between the buy strike, the 305, and the sell strike, which is 310. So in the perfect world, you can put this on for 22 cents and you could sell it for $5, maxing you $5.22. So if I put this up here, it should be, well, it says 5.15, implying that this, when this came into the calculator, you could have filled it at the midpoint of 15 cents. Well, that's where it's trading right now. But I really want to get, see, now it's bouncing up to 22. I would put it in at a 20-cent net credit, no less than that at all. And I would work it. And if it didn't fill, I would go back and readjust it. So it's a fun trade that you can put on for a net credit and take it off for a net credit. Yeah. And the Tradier Pro software actually does a really good job of showing you that this is a credit, showing that this side is the credit and this side is a debit, doing the math correctly. And I say that because there are some platforms where I see them not do it correctly, and it's very confusing if it's a net credit or a net debit. Kurt saying GM. I don't think I'm going to want to trade GM, but let's go back and look at in Google. We're just going to do a bull call spread, and it so right. So we're 295. So that works really well with the chart too. So we should see some resistance on IBM. It's going to have a real tough time going beyond this 295 level, at least closing above it, because that's an all-time high in IBM if we get to that level. Now, so we're right about here. So if anything, it should at least pause, right? Which gives you time in this strat. Yeah, I like this trade a lot because of this chart too. And then you're looking at 305 to 310. Yeah. Wondering if there's a way we could even get a little bit more of a credit. I'm going to make that the official paper trade, but let's see what happens. Do we got a 302 strike? Because I'm not like it. I do expect to see a pause right here at this new high. 302, 307.50. All right. That's a 25 net credit. Yeah, that didn't really help much. By going down 2.5. Yeah, it didn't really help much. Let's keep it right at the 305. You didn't get, I'm not seeing much. I mean, the stock is obviously moving. It's up 1% today. It's up $3 on the day. I would put it on closer to the close. I don't mind doing it right now. I don't mind that trade after it's already moved up 3 points today. I don't mind putting it on at this point. But normally, if you're doing earnings trades, you do them closer to the close because you're doing them based off of what you think is going to happen in earnings. Okay, so let's go to the Google chart. And in Google, oh, good morning. Kurt, I always think of that's funny. Good morning, Kurt. I thought you wanted me to look at GM. Yeah. See what happens when you assume? I don't need to go into too much detail on that. So with Goldman, well, no, not Goldman. Goldman's what we did the other day. With Google, doesn't look like I grabbed that screen grab. We did a bull call spread. Well, let's set one up. I just want to get bullish on Google, and one of my favorite ways to trade something around earnings that I like, that I do expect to move to the upside, is to just straddle the market. So if I were putting a Google trade on today, stock's right at 189.72. It's down $61 or $1.61 on the day, which is nice. It's right there. So we can easily straddle the market. I want to make it a 50-50 play, in that I'm going to go equidistant in the money and equidistant out of the money because I am bullish on Google. I'm going to risk one to make one. I'm going to risk two to make two, that type of scenario, okay, depending on where we land on it. So the expected move on Google, let's grab it. We'll go 10 hit the ask, which is the expected move. $11.15, which that's usually about right. 11.15, that's probably 5% divided by 189, 5.8%, almost 6% is the expected move. So in this instance, that we want to make sure that we're within the expected move. If we're correct, we want to go beyond our short strike. So if we go down, I think I want the 182.50, which would be 7.5 points, and 195. So we're talking about 15 points. That's going to be $7. That's going to be too much. That's probably what I would do. But I think for the show, we're going to talk about doing 10 points. So it'll be around $5. Okay, so 185 is the ask. Let's clear this out. 185 is the ask. 195 is the sell. The market, the expected move is 11 points, which is around 200. So we're well within that range. And we're doing this because we're going to want to pay around $5. So this is a 10-point wide spread. We're paying $4.70. So we can, and we'll make it $4.70. Click it in there so it stays. And so we are risking $4.70 to make $5.30. And how did I know that it was going to be a one-to-one risk reward scenario? Is that if you look at the extrinsic value, which I always like to keep that, that's one of my tabs that you don't, that a lot of people don't. I always like to just know what the extrinsic value is, the time value, the price of the option minus the in the money amount. And right here, it's $3.41. That is what we are buying. What we are selling is, this is all out of the money, right? So the midpoint is $3.52. So we're buying almost the same amount of time as we're selling. And if you do that on a long spread, it can be a long put spread, it can be a long call spread. If you buy the same amount of time as you are selling, you basically take the time premium factor out of the trade. I mean, it's still there. You still need time decay to happen, time decay to go away in order to receive the max profit. But the fact that Google is announcing on a Wednesday and we're going to have 2 full days to do this trade, that's all right. I don't mind it as much. Like if we were on a Thursday, might look at a butterfly trade, look at something that's a little bit different. But this is 100% an earnings play, thinking that Google will go up after the earnings announcement tonight after the close. Tesla is also announcing, but I don't like to touch Tesla at all. Tesla it doesn't trade on its earnings. It trades on whatever is mentioned in the conference call or whatever is not mentioned in the conference call afterwards. And that's always the scenario. So I just stay away from it. Now, if you want to on the Google trade and you want to give it a little bit more time, maybe after earnings, is you could go out to the August 9th. You'd use the same scenario. You would try to buy as much time premium as you're selling. Matter of fact, you'd probably just keep the strikes the same. And it would be very close to in price. The price really wouldn't change much, but you have more time. So here's the downside of it. You have more time for Google to announce earnings and to get above the top strike. But if it gets above the top strike and you have too much time premium in it, you won't get the max gain until closer to the expiration date. So to show you that that's true, just to make this into an option pricing options guide TV, this is 470. Let's just change the date. We're going to keep the strikes here, and we're just going to go out to the August 1st expiration, and it's not going to change much on the price. And then we got to go here. Notice it's actually the exact same price. And we are in the August 1st. Because once again, you're buying more time premium than the July 25th expiration, but you're selling more time premium too. You're taking the time premium factor out of it. Now, here is the downside, is that if Google opened tomorrow at 195, so I'm talking about a rosy scenario where our forecast is correct, and it opens at 195, this would not be at the max gain, where this one would be very close to the max gain. And the max gain is meaning that the spread would be trading close to $10. Does that make sense? Oh, Chad, yeah, interesting, Chad. What was the fill price at? Did you get to 20 cents? Go ahead and toss that one up there. Chad said that he executed it. Now, that one, there we go. Filled the IBM skip strike. Was it 20 cents? 22. Yay. Good. I knew that's where it should be. That's where it should be. Wouldn't want to get much less than that. All right, everyone. There's a small delay. Any other questions? We're bumping up against time. It's 11:29 right now. Got the rest of the day to trade. And yeah, we have earnings. Google, IBM. You know what I think will be an interesting one tomorrow, but it's tough to trade as NASDAQ. I think NASDAQ will do well tomorrow. NDAQ. It's quietly does well, but it's really the thing that I hate about it. Look at the NASDAQ chart. Isn't that crazy? It looks like a tech stock. And I think that they'll have a good earnings reports, mainly because a lot of the financials that talked about trade, that do a lot of trading, a lot of the JP Morgans, the Goldman Sachs always said trading volumes were up, and that was because of the volatility at the beginning of the year, because remember the reporting, the quarterly results. So I think NASDAQ will have a good earnings report, but the option contracts are horrible as far as liquidity is concerned, and that's the exchange that trades option contracts. So somebody needs to go down there and NDAQ and crack a whip and tell them to get their bid-ask spreads a little bit tighter. Yeah, it's not bad on the August 15 ones. We're 15 cents, 20 cents, 20 cents, 30 cents. But after the earnings, they'll get a little bit scarier. Like look at the September 18th, 410 by 3. So we're talking about 30 cents there. A dime isn't bad there. It's all right, I guess, around earnings. But I do think that they'll have a decent earnings report on Thursday morning before the open. All right, that's it. So Chad says I needs to drop to fill. Okay. IBM needs to drop to fill to get that 22 cents. Yeah, that would make sense. So when you initially put on the trade on the skip strike butterfly, well, it's kind of schizophrenic as far as what you want to happen. So when you initially put on the trade, if the market goes down, that helps the trade to initially start. As time decay happens, you want the market to go up. So once again, the best case scenario, once you execute the IBM trade, is that you move half of the expected move to the upside. And that is where you close on Thursday. And then on Friday, it continues and drifts higher towards your short strike. That is the best case scenario that you can get. If the market goes down, though, you take your 20 cents and you move on. Not a bad day's trade on $500 requirement. And you do it a few times, and that's not a bad trade overall. We did the same thing in Netflix with the same outlook and the same forecast, and almost the exact same chart as IBM, honestly. You can put them almost right up on top of each other. All right. Thank you for coming in and stopping by. We'll see you this Friday and see how all these trades play out. And then next week, we got more of the mega tech stocks, Amazon, Meta. We got quite a few that we'll be announcing next week. And next week will be the basically the heart of earnings season. So make sure you tune in Monday, Wednesday, and Friday, 11 a.m. Eastern time inside the Tradier Hub. Also follow it in the Tradier YouTube, and you can follow me on X. My name is Brian Overby, and my handle is at BrianOverbyNX.com. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.